Hello everyone! Last time we analyzed in detail a pretty long trading session, and based on that experience, among other things, we made some conclusions about flat markets and volatile markets. Let's dive a bit deeper into this. Prior to getting into crypto trading, volatility felt like a very scary word. When you hear it in the news that this or that market is very volatile, you tend to assume that it is necessarily a bad thing. You tend to associate it with being unpredictable, unstable, and above all, risky. And I am not here to disprove any of that. Unpredictable, unstable, and risky is exactly the right choice of words. However, this is looking at only one side of the coin. There is also the other side, which is opportunities to make money. Let's put it this way. A flat market is like chilling on a float in your backyard pool. It's nice, it's safe, it's warm, it's comfortable, but it is not all that exciting, and you are moving absolutely nowhere. And it is absolutely fine if that is your thing. A volatile market, on the other hand, is like whitewater rafting. It is cold, it is wet, it is uncomfortable, but it can be extremely exciting, rewarding, and you will be going places. The crucial thing, of course, as I keep on repeating, is knowing exactly what you're doing, being prepared, and managing your risks. A few videos ago, we concluded that to make money, the change percentage between the buy and the sell transactions must be greater than the total fees. Therefore, the greater the change, the more profit we are potentially making. When the amplitude of price movement is low, the profits are also low, or even non-existent. Another component of volatility is time, meaning that a change of X% over 1 minute may indicate high volatility, as it is not usually expected and represents an outlier, while the same change of X% over, let's say, a week may be considered low volatility since it is more or less expected to happen in this market. In the very simplest terms, I see generally two ways of making money. One is to take advantage of bigger changes to make higher profits per trade, while the downside of this is that these events may not happen all that often. Another way would be to make more trades more often at smaller change percentages. These will have much smaller profits per trade, but they will accumulate over time. At this point, to me personally, the second option seems a bit more attractive. Let me explain. With more frequent trades, I will be able to gather more statistically significant data that can be then analyzed and fed back into the strategy, creating a feedback loop of continuous evaluation and improvement. Let's put a pin in this for now and switch over to another consideration: the human factor. As evident from the aforementioned trading session, even with a laid-out strategy, executing it in real time by a regular flawed human being is not fully reliable. The problem with this is twofold. Firstly, with manual trading, you have to continuously stare at the screen, trying to analyze what's going on and make decisions accordingly in real time. And being a human, you will inevitably be attached to certain outcomes, even though you may have some tools to try and mitigate this attachment, such as having limit orders set on both sides of the current market price, above and below. And you will be attached to winning every single trade as well. That is true. Believe it or not, I personally find it extremely difficult to actually execute my stop-loss policy. Case in point, I made a buy of BTC at around 23,000, and then, rather rapidly, while I was not looking, the price dropped dramatically to under 22,400. And here I am, sitting with an open position that, if closed, would give me a 3% loss. And it is kinda hard to pull the plug on it, especially since I had a previous experience where the price climbed up really fast while I was not looking, and it gave me an opportunity to close my position at over 1% profit. The second part of the problem with being a human is that if a human rather frequently deviates from the strategy in its execution, the data points collected for further analysis of the strategy will be contaminated. At the end of the day, you will be analyzing not purely the performance of this strategy, but more of a hodgepodge of small and large variations introduced by the human. It would seem more reasonable to let the results of the strategy speak for themselves when analyzed clinically after the fact, rather than in the midst of a heated trading session. Now let's tie all of the above together. We have high-frequency, low-profit trading, which yields itself better to analysis and to a continuous improvement feedback loop. And we also have the desire to mitigate the human factor as much as we can. To me, this spells automated algorithmic trading. And this is where I will be looking next, and I will report back to you with the findings.